Hi, everyone. Curtis Edwards here, Chief Lending Officer of Orion Lending and host of Tea Talk with Curtis, powered by Orion. We have a very special guest with us today. No introduction is really needed. This gentleman is a bestseller on Amazon, is a serial entrepreneur, has multiple businesses that he has started, including MBS Highway, Experience.com, and a few others. I welcome Barry Habib to the show. Barry, welcome.
Thanks so much for having me, my friend.
Appreciate you being here. So you've had quite the career. Founding MBS Highway, mortgage market guide, healthcare agent solutions, certified mortgage associates, as I mentioned, experience.com. So many more things. What is the best, or maybe the one piece of advice you would give to some of the mortgage community on balancing while building their business?
Well, balancing is a very tough thing to do because you have to have some periods, if you're especially trying to launch a business, that that inertia, that liftoff takes enormous energy and commitment. So you're probably going to be in a lot of periods of that will be out of balance for your life because you're going to be devoting hours to this that are going to create sacrifices in your home life and in other things that you might enjoy. So you have to be willing to pay that price. I'm not making decisions for people and saying whether it is worth it or not worth it to pay that price, but it's a decision that you should be ready to make. I don't think you can be, in the vast majority of cases, very successful as an entrepreneur without making that commitment and that level of sacrifice. And with anything that you want to be successful, you have to go through periods of extreme imbalance to potentially achieve a more balanced situation. Listen, I'm still a work in progress when it comes to balance because, like any entrepreneur, when you have a business that goes on a lot, that becomes part of who you are because it's part of what your makeup is. If you have that level of love and passion for what you do and for the business that you're doing and the results that it creates, not just financially, but the difference and the change that you make in others' lives and in the world and the good that comes with it to for your family. Curtis, I don't want to go too deep on this, but just real quick. So I made a lot of sacrifices with time with my kids. Now, I did spend a lot of time with my kids, of course, and I've always been, I am a good dad. I know that. I say that with confidence. But there was a lot of times where my kids did have to sacrifice. And I know when they were little, they didn't really get it. But now, my son Dan, my son Jake, my son Jared, they all work here with me. My daughter Nicole worked with me for a while. She's a loan originator now. And they all totally get it and totally understand why and the sacrifices that had to be made. So they always assure me and yeah, Dad, we get it. We know why. We see now what the difference is that you made in other people's lives and the good things that we have, the things that we've learned. Everything takes some sacrifice, and that's what gives you appreciation too.
Absolutely. Great response. So Barry, you had some slides you want to share with our listeners?
Listen, I want to talk to everybody about what's going on in the market right now. Listen, rates suck right now. So I think I can understand if you're a loan originator, even if you're a real estate agent, the frustration that's going on. So listen, I want to own something here. I was very public and while over many years of calling rates, we've had the very vast majority of them being right. And in fact, some unbelievable calls that we made as far as interest rates go. And, we manage this on a day-to-day basis and we do that effectively. But at the beginning of the year, this year, this is after many years, and in fact, being the only ones that got it right on saying that the 10-year treasury is going to go down to 0.5%. Everybody thought we were on drugs.
I remember
exactly that. 0.5%. We were the only ones that got it right on the housing market. Everybody said it was going to be a crash. We made a call the beginning of this year, and we said, believe that starting sometime in May, that rates will begin to head lower and come down. Now, we were dead wrong on that. But our thesis for it and the explanation that we gave everyone was we said, we are counting on inflation starting May to decline, and mortgage rates historically always follow inflation. So that was the thesis that we have. So as it turns out, we were correct on inflation. We're dead right. One of the only ones that got it right. Inflation dropped rather precipitously starting in May. So if you go from where we went from May to June and July to August now, we've seen a huge drop in inflation. Mortgage rates, not so much. They've gone the other way. So this is a break from history. And my good friend David Rosenberg, he wrote a piece that said, we've seen inflation come down since then 500 basis points, and mortgage rates would typically correspond. He said the 10-year treasury would typically correspond by dropping 120 basis points. Instead, they've risen 100 basis points. So that 220 basis point swing, if you applied that to mortgage rates would be exactly where we had forecasted them to be, but it didn't work out. You had a debt ceiling crisis with 270 billion of extra paper that had to be sopped up. You had a Fitch downgrade. You had a banking crisis where assets had to be sold. You had the takeover of the 3 largest bank failures since, aside from WAMU, that had to be taken over by the FDIC and sold. None of those help, but the main culprit, the main one, is the Fed. And the Fed has been maniacal. They don't get it. They don't understand it. You've got an attorney who is the Fed chair, not an economist. You've got the lead governor, Michelle Bowman, is an attorney, not an economist, no business experience, leading the charge with a few others like Mary Daly, who's just a head scratcher, for higher rates, more work to do, multiple rate hikes, and it's shell-shocked the market. The mortgage rates used to ride 2% over the 10-year treasury. Now they're 2% over the Fed funds rate because the Fed funds rate has exceeded that. Usually have the 10-year treasury here and the Fed funds rate's beneath it, right? Almost all the time historically. Now you've got the Fed funds rate here. So mortgage rates are 2% above that as opposed to the 10-year treasury. So what's it going to take? It's going to take, in my opinion, we're going to see inflation continue to decline, but that's not going to be the trick. It's going to be a shitty jobs number. We need a bad jobs number. Now, today, this morning, we got the revisions. It's way back. It goes from April of 2022 to March of 2023. And during that period of time, we already saw that the jobs numbers overstated the amount of jobs by more than 300,000 bogus fake numbers that came out. Now, we're going to get another revision, which will even be deeper than that, but we don't get that till February. But that's through March of 2023. What was the big event in March of 2023? SVB. That happened March 8th. So it didn't capture that. Nothing happened in the 3 weeks afterwards. All the crap hit the fan in the weeks subsequent when you had First Republic and you had Signature and you had the FDIC seizing assets, and now banks had to raise capital by selling mortgage-backed securities. None of that happened. And as a result of this, we've seen banks tighten credit. We know that's going on. We know the consumer. Look at all the retail sales numbers. Consumers, very weak. We know theft has gone through the roof. And we see the jobs numbers are, again, very misleading because in just the most recent jobs report, you had 600,000 full-time jobs lost. Hours worked declined significantly, but we gained jobs. How? Because we added 900,000 part-time workers. You know where the strength comes from? Those over 55. Now, hey, I'm in that category, okay? But the prime working age of 25 to 54 lost jobs. This is not signs of strength. The market's trading on this bogus stuff. And what you're going to see is eventually we're going to get a lousy jobs number, and that's going to turn the tide. And you should mention 2 other things. Our leading economic indicators, 16 months of road in negativity. So if you look through the front window, the road doesn't look so great. If you look it through the rearview mirror, oh, that's great. But that's what the Fed does, looks through the rearview mirror. Last point on this. The short interest in 10-year treasuries is at an all-time high of $800 billion. Short interest. Now, these mean, for everybody to understand, what's short mean? If you buy a stock and you're betting for it, if you buy a stock, you hope that it goes up. But if you think it's going to go down, you don't want to buy it. What you do is you sell it, but you sell it without owning it. So how do you do that? You borrow shares and sell those shares. Now, because you've sold something you borrowed, you got to replace that borrowing. So you're short that amount of shares, hence the name short. So at some point in time, I've got to repurchase them. I've got to buy them and create buying pressure, right? Now, in treasuries, it's the same thing. So there is so much sold short on treasuries that if we get some good news, if Powell stops this maniacal quest, like today, we got numbers from Europe that showed that the economies are slowing down. China's slowing down. We got a major bond rally today. 10-year treasuries down 11 points. Mortgage bonds are up 61 basis points. I'm looking at it right now. Just on a little bit of news. Why? Because the shorts are selling. Now, why can't we extend this rally? It's because on Friday, Jerome Powell is going to speak at Jackson Hole. And the fear is he's going to piss all over this thing. And that's what we should be bracing ourselves for. If we can get some lousy job numbers, if we can get the Fed to start turning the corner and doing the right thing because inflation's dropping, then what will happen is you will get a very strong rally. And with the short position, it will move in our direction in a rapid manner.
Absolutely. So today's a great day to lock.
Today might be a really good day to lock after getting the rate sheets. It might be. You know, we want to see if we get a little bit of an extension of this rally, but if there's some give back or weakness, this will be the opportune time to lock.
Yeah, we saw that this morning when we were doing our marks as well. And it's a pleasant surprise, considering all we've seen is pricing deterioration for as far as I can remember back, day over day.
While many other lenders will only allow for brokers to submit a full broker application in order to get approved, you can get express approved by Orion Lending within hours and no credit pulled. Just imagine, you could be submitting loans with an out-of-this-world lending partner by the end of the day. What are you waiting for? Visit orionlending.com to hyperspeed your business today.
Very good, very good. So you mentioned the slides. Did you want to go through those?
Let's do that. Let's do that real quick. So here we go. So I think you can see those right now. So look, we want to have success in today's market in LO. So I'm going to go fast. So let's put your mental roller skates on. You may want to take some notes if you're watching. So let's get ready. So the first thing is, what do you need to do? You need to increase your income now. I hear this all the time. Look, I've been in this business. It's hard to admit, but it is true. So I'll admit to this, 37 years, over 20 years, originating loans, owning companies, originating loans. So I can understand what you're feeling. I've been through some really, really bad markets as well. And this one, lines up as a really bad market. So this is not something that, I am not unfamiliar with. So you need to increase your income right now. What are you going to do to increase your income? I'm going to talk about that right now. I'm going to give you a strategy, and I want you to gain market share. How do you do that? By being the answer person for your realtors. You have to understand that real estate agents have challenges right now. You can either bring them bagels and say, hi, give me a loan, or you could solve their problems. What are their problems? People with a loan that they have on their existing home of 3.5% that are hesitant to buy a home because not only is the price higher, but the rate's 7.25% or so. And there's a hesitancy to do that. Another is, hey, maybe I'll wait for rates to come down. Another is, the inventory levels are so tight that in order to get this home, I've got to bid over ask. 40% of homes are bid over asking price, and almost all of them have multiple offers. Clients also have a fear of a housing bubble. Can you solve these for realtors? Because if you do, you'll protect your referral sources from being poached, and you'll grow your business with new ones. So let's start with the first one. So how much business is out there this year? So there's going to be 4.1 million existing home sales, 700,000 new home sales. So that's 4.8 million real estate sales. Now, not all of them have mortgages, but 3.6 million of them do. And while you might not believe this, there's 1.3 million refinances. There's 4.9 million mortgage transactions. You don't need all 4.9 million, ladies and gentlemen. How many do you need? What do you need? You need 30, you need 40, you need 50, you need 60. So that's the way you should be thinking. Look, if you do 2 mortgage transactions a month, 2, so that would just be 24 out of 4.9 million. You would make $100,000 a year, and that would put you in the top 15% of income earners in the United States. Now, maybe you need to do 1 a week. That would be $200,000 a year. Whatever it is, let's work on a plan to do that right now. So here we go. Let's understand this. The personal savings rate in the United States, pre-pandemic, pre-recession, people forget there was a recession earlier in 2020. We had a double whammy, was 10%. We had that double whammy, and the government came in and said, hey, you know what I'm going to do? I'm going to give you a big fat stimmy check. So a stimulus check comes in, the economy shut down, people threw it in the bank. At the same time, they had jacked up their credit cards to all-time highs with no place to spend it since the economy shut down. They paid off their credit cards. But we had another stimmy check. Now the economy still need to wear a mask, but it's open. I could buy stuff. Let me come out like a caged animal and buy it. And we spent that stimmy super fast. No worries. Got another one, even bigger. The budget Biden buster comes up and we spend that even faster. And then what do we have? Now I want to keep this party rolling. So what am I going to do? Well, I got a plastic that's all, ready to go. I got dry powder on my plastic. So I'm going to jack up my credit cards. I'm going to drain my savings because I want to keep this lifestyle going. I love it. And now our savings rate's below 5% and our credit cards are over $1 trillion. Over $1 trillion is an all-time high, but it gets worse because a year ago you were paying 14%. Now you're paying 25%. Thank you, Jerome Powell. And what else? Unpaid balances are up 16% in the past year. The amount of credit card balances in total is up 270 billion. balance on average per card is $8,000 per card versus $4,000 a year ago. And delinquencies on credit cards, they're up 50%. This sound like a strong economy to you? Not to me. New car payments, the average car loan is down. The average new car cost is $48,000 with a car payment of $1,044. HELOCs are over 9%. So what do we do to help people solve for this problem? Well, just like any good football coach, you want to take what the defense gives you, right? What is the defense giving you? Equity in homes. The average amount of equity is $249,000, and the amount of cash out that you could pull is $199,000. So people on average have $200,000 in equity they could pull out of homes. Hey, Mr. and Mrs. Client, should we talk about refinancing? I don't talk about refinancing. I got a 3.25% rate. Do you really have 3.25%? Use a blended rate calculator to show, okay, you got 3.25 on your mortgage, but what about all your other debts and the rates you're paying on that? Your rate probably is over 4, it's over 5, maybe over 6, maybe over 7 when you take everything into consideration. So what do we do? Well, I'm going to call my clients, and what I'm going to try and do is help them by consolidating their debt with a cash out refi. I'm going to give you a script of what to do in just a minute, but let's take a look at a real case study, true case study. And we get dozens of these every day from our subscribers, our 40,000 subscribers. We get dozens of these every day, people telling us what they're doing. So somebody bought their home 4 years ago for $500 with a $400,000 loan. That home's gone up in value. The loan through normal amortization has gone down. But you refinance this person a year and a half ago at 3.25% in 2021. So the time remaining on this is 28 and a half years, and they got 3.25%. If I do my 7.25 today, I got to hit them for another $3,000 in closing costs. What are you, crazy? That's going to make my payment go up $796 a month. I'm not going to do that. But Mr. and Mrs. Client, you got all this debt and you've got all this equity. Your current LTV is 55. Remember, the current LTV average is 42. So 55 LTV. That means I could pull you up to a 75 LTV max, and without, any heartburn. I've got all of this white space, which is money, which we tell you, you've got $130,000 that you could eradicate all your debts. So what if we did that? Let me wipe out your debts, increase the loan amount, bring you to a 71 LTV, and I'm going to save you $1,556 a month, $1,556 tax-free. That's the equivalent of $35,000 a year if you went out and got another job. This is the difference between that guy or gal having dinner with their family or going out at night and having to work Uber to make ends meet. This is like having one of the spouses stay home or now having to go out and get a job. This is something that is life-changing and people don't know. Now, remember, they're making the same payment that they made now and saving $1,556 because they've eradicated their debts. And what I want to explain to you is what if you've got somebody that says, hey, man, right now I'm okay. This will be found money. So yeah, keep making the exact same payment you're making today on everything, your credit cards and your mortgage, but put it all on the new mortgage I'm going to give you. And what does that do? It's like a miracle. Watch what it does. See, you have 28 and a half years left on your mortgage now. When I issue this, it says a 30-year, but by you making this additional principal payment with found money, you apply it towards principal, and your new mortgage is only going to have a 12 years and 8-month remaining balance. You're going to save them 15 years and 7 months. 15 years and 7 months. That's 187 payments. This is the best retirement plan in the world. Why? Because you didn't change anything. You're making the exact same payment you are making today and just doing it in a smarter way, consolidating your debts and accelerating the payment and getting amortization benefit, which you wouldn't get on a HELOC, which is at a much higher rate. And you're going to save your total aggregate payment of $6,000 a month, 187 times. Wow. How much is that? Over life, it's a big amount, but you don't have to wait 12 years and 8 months to be happy. In just 5 years, you start saving in month 1. So in 5 years, you've saved $96,000. In 10 years, you've saved $243,000. And in 12 years and 8 months, you've saved $345,000. See, that's what you'd have left on your debts and on your current mortgage, which is so precious to you at 3.25. Would you rather say I got 3.25? Would you rather say I got $345,000? This is what we have to show people. So what do? Here's our plan. Here's how you win. Now, does this apply to everybody? Of course not. You have to have people that A, have equity, that's likely, and B, have a good amount of debt, which is going to happen sometimes. Not everybody. So what do? Here's what I want you to do. Start today. You did a bunch of loans in the past few years. You got a bunch of previous clients. I don't even know how many previous clients you have. Maybe it's in the thousands. Maybe it's in the hundreds, but it's a lot. So what are you going to do? You're going to call 5 past clients a day. Is that call a terrible call? No, it's not a cold call. It's not, hello, I want to introduce. They know you. They like you. They loved you. You saved the money. Hey, Mr. Miss, oh, Barry, how's everything? That's great. Yeah. Hey, I just wanted to check in with you. Who knows? They might, you know what, Barry, I should have thought of this, but my neighbor just told me that they were thinking about buying a home. Let me put them in touch. Wow, I picked up a lead just from saying hi. But here's what you're going to say. Magic words. The last time we spoke, Mr. and Mrs. Client, we saved rate. This time, let's talk, because let's try and save some years. Let's try and do something for your future, for retirement. Let's try and do that. Wow. Now, look, here's some numbers for you. If you make 5 calls a day for the week, that's 25 calls at the end of the week. Now, clearly not everybody's going to pick up on first ring, okay? And you're not going to even get in touch with everybody. So I'm not saying you are. Now, you might, but what if you only make contact with 20 past clients? Now, that's likely because these people like you. They're friends. They know you. So you'll probably talk to even north of that, but let's just say 20. Out of the 20, not everybody's going to apply. It doesn't. Some of them have no debt. Some of them may not have enough equity. Some of them, may not be interested. But do you think you can get 1 out of 20? That's $4,000 a week, ladies and gentlemen. That's $200,000 a year. Now, what if you don't get anybody in week 1, but you get 1 in week 2 and 1 in week 4? So 2 loans for the month. That's $8,000 a month. That's $100,000 a year. Do you have the extra time? Look, I mean, if you're so busy right now that you're writing 25 loans a month, okay, you don't need this strategy. But if you're, rather than complain that the market's slow, pick up the phone, call 5 people. Just do it. We get dozens of these every day where people say, wow, man, I recently helped a customer go to 7%, lower their payment by $3,000. People need this, folks. Look, take the same philosophy, apply it to a purchase. And this is the answer for your realtors. If I were you, I'd be going out and talk to every single realtor out there. Hey, Mr. and Mrs. Realtor, you have a client's got a low rate. They're worried about the higher rate today and they don't want to move. Well, let's take a real case study. $500,000 home, $400,000 mortgage 6 years ago. That home's worth almost $695 now. The remaining loan balance is $343. So how do people figure on a move up? They say, well, I can sell it for $695. I owe $343 plus the cost to sell. I'm going to net $317 to put down payment on the new home plus closing costs. Closing cost on the new home's $12. I could come up with a $305,000 down payment. And that's the way they think. Now, the home that they need, because they just had a kid, they need another room. They would like an office. They want a different neighborhood. They want a different school system. They want more land. Whatever their reason is, they want to move. Their dream home right now would be $850. Less the down payment means they need a $545 mortgage, but at 7.25%, that's going to be $2,700 more than what they're spending now. They're also reluctant to give up that beautiful badge. Oh, I got a 3.25% mortgage. Look at me. But what if they got debt? Let's use a real case study here. So in this particular case, that $2,700 doesn't look good, but this was going to be a 64 LTV. What if you take them to a bigger LTV, higher LTV, use some of that money, eradicate the debts, bring them to a 78 LTV? The monthly payment differential is $97 a month. I don't know if you guys follow Tim Brahim. He's phenomenal. If you don't, you should go to his L360 coach and podcast, and he's got great tips. He has people on with great tips. A month ago, we had a guy, Eric Bible, from San Diego. And Eric talked about how he's using this strategy and doing 3 or 4 purchase loans a month. And his realtors are losing their minds. Protect your realtors from being poached. Get new realtors. Have answers, not bagels. Here's another one. Well, Barry, I don't know. I'm not going to buy right now because I'm hearing rates are going to come down. I agree with you. I think rates are going to come down. So if it's 7.25% now in 6 months, could they be 6.25%? Yeah, I think that's possible, especially we get some bad jobs numbers. We get towards recessionary conditions. The Fed eases off the neck of this thing. Maybe. But does it pay to wait? Well, first thing is we have the appreciation for every area. So we know that in this particular area, Monmouth County, New Jersey, and we could apply to anywhere, but specific to the zip code too, appreciation is going to be 4.8% for the year. Nothing crazy, 4.8%. That's actually below the forecast for nationwide, which is 5.8%. So 4.8%, pretty conservative. That means in 6 months, half of that's 2.4%. 2.4% is $19,000 appreciation in 6 months. Okay, so how does that pan out? Well, if you needed an 80 LTV, instead of borrowing 640, you got to borrow 647. So still, though, at 6.25%, your payment, if you waited 6 months, you're going to save $380 a month if rates come down. I get it. So let's do the math. 6 months of saving 380, it cost you 2280, and then you could refinance to the lower rate of 4,000. So maybe it's a bad idea because it's going to cost me 6280 to do it. But wait a second, what about the appreciation? What about the amortization? That's $22,000. So should I wait 6 months or should I buy now? If I buy now, I'm better off by $16,000. Plus, when rates come down towards 6 or under 6, what do you think is going to happen to prices? They're going to jump up even more because you're going to get many more buyers. For every 1% drop in rate, you get 5 million more qualified buyers. Of course, not all are going to buy, but more competition. Inventory is already tight. Do you know that more than a third of homes, it's almost 40% now, are bid over asking price? How does your client understand that? You've got a realtor. You've got a customer. You worked really hard. You pre-qualified them. You and the realtor work together. You got somebody, they're ready to go, and they put in an offer. Somebody outbid them. How do you help that realtor win the deal? How do you help you get that deal for yourself and your family? How do you do that? You have to show your client if it makes sense for them to bid over asking price. Do you do it by trying to pump them up? Oh, get the house you love. No, you don't want to do it emotionally. You want to do it logically. And you can use the bid over ask. Take a look. Real case study. Price for the current home was $469, and we have an AVM within MBS Highway. It's called the MBS estimate. It is $649. In order to get this home, they got to bid $10,000 above asking price. So the total bid's $659. Here's what we got to teach the customer. How long will it take for this home that's valued today at $649 to reach $659 for you to break even? How long do you have to wait? And how long, what will happen in the future? Is this profitable? And we can tell you, because in 5 months, you need 1.54% appreciation. The appreciation for this area is 5.96 for the year. So it'll take you 5 months to break even. That's not so bad. So wait a minute, I'm closing in 60 days. So that means 3 months after I close, I'm broken even. That's not so bad. Okay, what about the future? Well, the forecasted appreciation for this market on average over the next 5 years is 4.47% a year. And that is very close to what it's been the last 63 years at 4.33%. You're going to make $158,000. Wow. What if I had to go 15,000 over asking? What if I had to go 20? Heck, if I'm going to make, instead of 158, I make 153 or 148, maybe I will. And you win the deal. Your realtor wins the deal. You want to find out how everybody in that real estate agent's office is going to work with you? This is how you do it. Now, you can complain. You can say the market's tough. You can go buy everybody bagels, or you could take an approach that wins. And this wins. We hear from people every day. I got last one. Everybody's worried about the housing market. Everybody thinks the housing market's going to roll over. Here we go. This is the last 81 years of home value appreciation. 75 years it went up. 6 years it went down. One of those 6 years was less than 1%. Okay. Everybody worries about this period of time here. Now, everybody's freaking out because in the last 3 years, prices went up 10%, then 19%. And in 2022, we were the only ones that got it right. Prices went up 6% while everybody else said it was going to be a crash, but they still went up 6%. And this year, they're already on the way up. So when we take a look at something like this and we say, hey, it's going to be a crash, right? Because it went up so much. No. Look at this period of time. Prices went up. Forget this. They went up 118% in 6 years. If you waited for a crash, you'd have to wait 59 years. And during that time, you missed out on another 93% rise in a 6-year period. Everybody worries about this period of time. But what was going on here during this period of time? We had the crash. There were imbalances. Imbalance number one, 4 million homes in inventory today, 1.1 million. And number two, households being formed at this period of time were less, much less than builders putting up more homes than we ever saw before. Today, builders are putting up much less homes, and demand by household formations is much greater. You want to know why real estate values are higher? It is simply the first law of economics, supply and demand. During this period of time, what was your mortgage application? Can you fog up a mirror? Okay, great, approved. You don't need no income, no asset, no job, lousy credit, no down payment. Heck, what could go wrong then, right? Compared to today, I don't have to tell you what underwriting is today. So don't compare the two. This market, as long as you have more household formations, the law of economics, values go up. Now, people will be telling you, oh, well, aren't home values going down? Forbes magazine puts this out there because they don't understand math. They say median home price drop. Well, median home price is not appreciation. Let me tell you the definition, the mathematical definition is the middle price in a series of numbers. So let's assume that 5 homes sold. And those 5 homes, lowest to highest, the middle number is the median. That's the median home price. So let's say in the following year, values went up just like they did in 2022 by 6%. All of these homes are worth more, every one of them. But if only 3 homes of these sold in 2023, well, then the median home price, if they were the lower priced homes, would be this one. You see, the median home price went down 12%, but it didn't go down 12%. It went up from 225 to 238.5, or it went up 6%. Understand the math. Explain it to your customers. Explain it to your realtors. They need to know. Look, every measure of appreciation, Case-Shiller, FHFA, CoreLogic, Black Knight, Zillow, are seeing prices rise. Now, January was like a transition month, but we've seen accelerating price appreciation everywhere. And the yellows mean that FHFA said we're at an all-time real estate value high for residential starting February and every month since. CoreLogic said it started in May. Zillow said it started in June, and all have hit all-time highs. Eventually, Case-Shiller will, whether it's in the next 2 months or 3 months, it's going to happen. But these are the pace of appreciation for 2023, between 5 and 10% appreciation. Values are not going down, folks. Tell this to your realtor. Now, the last time in 2012, what we had seen was values, this is a little bit overlapping here, sorry, but 8% appreciation from the bottom, but that was with 2.4 million in inventory. When you take a look at housing staying strong during recessions, don't be worried about recession. 8 out of 9 recessions, home values went up. Just this one, it didn't go up. And the reason was, again, much more inventory than homes. And if you take a look at that 4 million in inventory, our population was 301 million in the United States. What's happened since then? Our population's gone to 334 million, and our inventory has gone down to 1 million. So you got 33 million more people fighting for 3 million fewer homes.
Yeah, the data is amazing. I love seeing the numbers and seeing how they make sense. It really, when you look at I think a lot of realtors, borrowers, loan officers, when they get kind of stuck in it with the rate and the home prices, they're looking at the specific point in time that we're dealing with right now, not looking at the big picture of what historically has happened. Because when you break down the numbers like this, as you do, for the folks that subscribe to MBS and all the data you provide through there, it seems like an easy sell, right?
It should be. And then, look, average time on the market today is 20 days. You got under contract of the 1 million that's in inventory, 463,000 under contract. There's only 647,000 homes available. That's less than half of the pre-pandemic norm. Last year, we said 5.5% appreciation, came at 6. This year, we say 5.8. I think we'll be right. Thoughts from the front lines, one of the most respected newsletters. You guys should get it. It's free, goes out to over 2 million people. Everybody in finance reads it. John Malden, who writes it, was very kind to me a month and a half ago. He said, housing is a lot stronger than anybody would have thought it would be. Well, other than Barry Habib, because we were the only ones who got that right. Folks, what you should be doing is screaming this from the rooftops. You want to get exposure, take this QR code, be a host of Financing the American Dream in your marketplace. Get that done for yourself. Just go ahead and do that. It's very, very important that you have exposure, that you get these messages out. You need to get in front of people. Is one of the best ways to do it. And if I were doing loans today, I would go out with a message to my realtors. Hey, let me help you. When you go on a listing, let me pull an AVM for you, show you the whole neighborhood, that you could see the values. I'll pull all the comps for you. It takes 3 seconds to do it. And I'll give you a report to bring so you can win more transactions. Get a real estate report card that tells people how much money they're going to make. Get them excited. Show them the job picture. Show them household formations in their zip code. Show them everything in their current market they need to know. Co-brand it with your realtor. Sun Tzu, in his book, The Art of War, said every battle is won or lost before it's ever fought. When you go to visit a realtor, do you say, hi, here's some bagels, please, please, please send me a loan? Or do you take the time, which it'll only take you 5 or 10 minutes to do, go to a current listing so it activates their it engages their reticular activating system, their RAS, so they become more engaged on their active listing or recent sale. Co-brand it for them to show them an example and say, here's what I do with top performing realtors. I will give you these reports that'll help you at point of sale gain more listings. That'll help you at point of sale make more sales by showing the opportunity. Use it on social media. Use it in open house. This is what you need to do. This is what today's originator needs to do. The days of everybody throwing loans at you on refinance, that's gone. Okay. Now you got to really go to work. This is what you got to do. And if you go to MBS Highway, watch our updates every morning. It'll make you smarter and make you win more deals. And if you want to compare loans the right way with active and live explanations to them on what's going on. Show them the only tool that has out there that explains to them, look, you've got 3 different options for MI or for different loan amounts or different term repayments or different types of loans. The customer just wants to know what's the best for them. They could all be best for you. It depends on when. This shows you at what points in time each loan will be better and shows the appreciation. You can narrate this for them. This is what you need to do. Part of our platform, it allows you to have, just like we're doing here on a Zoom, allows you to have that. You can record a video message and send out a video message to them. Watch this 2-minute video. These are the things today's originator has to do. I'm just going to throw this up there for a second so people know. If you email Diane at MBS Highway, if you're on this, a 40% discount of what it normally is. Just email Diane at MBS Highway. If you want to get in touch with me, I'll put that on there real quick for you. And that is, I am Barry Habib on Instagram. And on Instagram, if you go there, I put a ton of reels up that you could take, use, steal for free, copy them, just send them to everybody that are all about these concepts and points that you can utilize.
Orion Lending is dedicated to hyper-speeding your business by continuously boosting their product offering and providing innovative technology within the proprietary Star Broker portal. New products and programs include Coin, cash flow only investor loan, as well as Titan Flex non-agency and Boost down payment assistance programs. Like what you're hearing? If that wasn't enough, Orion also offers a purchase pricing special for 0.375 bips on government conforming and a quarter on conventional and government high balance. Both are added as a positive LLPA to their rate sheets. Orion has a loan program to fit your qualified borrower's needs. With new products on the horizon, now is the time to hyperspeed your product portfolio with Orion. At the time of this recording, the purchase pricing special is an active special for all government-conforming, conventional, and government high-balance loans. At any time, Orion reserves the right to terminate this special without notice.
Great information. Barry, I really appreciate you joining the show today and providing our listeners with some real education on how to win over the realtor, the borrower, how to help them negotiate rate, and all sorts of different things that you shared. I think it's valuable information that hopefully people take heart of it, and you can get some more of those success stories emailed to you from those borrowers that don't want to give that 3.25. Because when you look at the numbers and you actually do the math on it, it's pretty amazing. It's the first time I've seen that slide, and it's pretty amazing how much sense it actually makes. Whether you're refining, cashing out, paying off debt, or looking to buy a bigger house in your neighborhood, or like you said, closer to schools and that sort of thing for the kids, it can make sense. You just have to have the right loan officer and the right realtor that understand the market, that can explain it to the borrower and help them understand how and where it makes sense.
And Curtis, you mentioned something before we actually went on affordability, right?
Mhm.
So I think that that's really a super smart point to bring up, because that is another thing that the media harps on. Is it's not, it's going to cost $800 a month more if you buy now compared to 2021. Well, guess what? Your income's gone up probably by more than $800 a month, right? So that is never taken into consideration. Is it more difficult because rates have gone up and prices have gone up? Does that impact affordability? Of course, but don't just show the one side of the coin. Look at the incomes rising too, because that mitigates, if not completely eradicates, the affordability issue based upon where we are. And look, if rates do come down like we think, you can make the argument mathematically it is more affordable when rates come down to buy at 6% than it was to buy at 3% in 2021, even with a higher price, because your income's gone up. So these are the things we have to explain to our customers.
Yeah, you mentioned jobs being really a driving factor for the rate environment as if they were to come down. What impact do you think the election is going to have on it?
It's very hard to say, and it is so early as to who is going to be there. I think the candidate from the Democrats will probably be Michelle Obama. That's what I think. I think from the Republican side, Trump right now is the clear front runner. But a lot can change.
Sure.
Ramaswamy's picking up a lot of interest, and as we speak tonight is going to be the Republican debate. Trump's sitting it out, but it'll be interesting to see that become pretty friendly with Roger Stone. And he's a fascinating guy. He's very, very interesting. I had dinner with him a couple of weeks ago, and Roger does think that Trump will be the nominee, but he thinks it's a tough go for Trump. He said because especially against Michelle Obama, it'll be very difficult overcome that. But then again, he says, listen, it's uphill, but not impossible for Trump to do that. But I think if he were to run against Joe Biden, Trump would have a really good chance.
Yeah, I would I would tend to agree with that. So as the 3-time Crystal Ball Award winner, are you able to give any sort of predictions for where you think rates are going to go in 2024, or when we might see a drop?
It looks like, for all the aforementioned reasons, that there's reason to believe that rates do improve, and they improve markedly. They improve significantly. When the Fed, we're headed for a recession or recession-like conditions. Inflation is headed lower, and the jobs market is not as strong. So those three factors all are very highly favorable for rates. As you start to see those turn the corner, you've already seen it on inflation, and you will begin to see it in jobs. And when you see it in the Fed, you're going to see interest rates come down in a significant way. I think that you'll likely see mortgage rates become much more attractive, 1% more, maybe more than that, more attractive than they are right now. And I think that increases buying activity quite a bit. It also bridges the gap for people that are hesitant. You're still going to have a big disparity to go from mid 3s to upper 5s, but people historically have done that. If you need the space, you need to buy.
Sure,
if I had
sure.
a kid, I'm not going to put my kid in the closet. Okay, kid's not going to sleep in my bedroom. So things like that are going to happen. People are going to move. People are going to need to downsize and sell. So people are going to need to buy even at the higher rates.
Yeah, from the lending standpoint, one of the things we've been focused on recently is scalability, right? When COVID hit March 2020, right, and the 10-year dropped, the applications were flying in the door. It was tough getting people in seats to handle those, underwriters, processors, that sort of thing. So one of the things we've been focused on a lot is AI and how it can help in scalability, streamline process, that sort of thing. But one of the questions that comes up in terms of AI is what threats does it pose? We've seen the chat functions of AI that are pretty insane to watch, and how they craft their messages. But how much disruption do you anticipate from AI in the mortgage industry in the next couple of years?
So AI has been around for a very long time. People don't realize it. It's become more in vogue, and it's something that people are becoming more exposed to, and more easily available for individuals. It's hard to tell, because it's something that will certainly help with research, with help with creation of documentation. I think from a mortgage originator perspective, you always run the threat of being replaced if you are not adding value. So where can you add value that AI won't add is all the things we talked about.
Relationships with realtors.
Yeah, relationships in ways that provide the answers for them, and relationships in ways that teach real estate agents about the housing market, about what to do in changing environments. When you have people bidding over asking, do you have a solution for that? When you have people wanting to wait, do you have a solution for that? When you have people that are hesitant to give up their lower rate, AI doesn't solve any of that. So
Sure.
you are able to provide answers that AI can't. Now, if you're just a salesperson and all you're trying to sell is a rate, and people I see leaving companies for shining objects. Well, this company has a lower rate, or this line or product line. Listen, that's just chasing shiny objects. There's probably nothing wrong with the company that you work with in most cases. So rather than look and put blame, why don't you look inward and try to improve?
Sure. Absolutely.
Of course, look, if you want to switch for good reason, switch for good reason, but don't chase shiny objects.
Rates can change overnight. All right, Barry. Thank you again for joining us. I know you're a very busy man, and take time out of your schedule to educate our listeners on some of your tips. I'm sure it'd be very valuable for them, and look to have you on again in the future.
Curtis, it is a privilege to be with you, my friend. I appreciate you and all the good that you do. God bless you, and God bless you folks that are listening. I wish you well. I know this is not the easiest of times, but use that fear, use that anxiety, and use it and take action. Don't do nothing, and don't use it to complain. Use it to take action, because you could be doing a lot of good. You could be making a lot of positive progress, and you're going to see some wins. I promise you, if you do that. And I also promise you things will get better. So have faith.
Absolutely. Thank you very much, Barry.
Thank you.
We'll see you again.